Major job cuts are imminent. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Indeed just issued a massive warning about the U.S. jobs market. And as you're about to see, this is not going to be limited just to the United States. We have new data today that indicates that within a matter of months, there's going to be major layoffs all over the world. Now let's head over to Bloomberg, where we picked today's story up with a headline: as job site Indeed cuts 8% of its staff in a second layoff in 2 years. And I want to put this in perspective, because if the company that is designed to help people find jobs is laying people off, that is a very big indicator of the health of the labor market. And we can continue to see from companies like Walmart, Target, Home Depot, Lowe's, McDonald's saying the lower income cohorts are running out of money. They're spending less, and in the end, that leads to fewer jobs. We're seeing it now as Indeed looks to lay off more. And the cuts come after they've already slashed 2,200 positions last year in a bid to trim costs amid slowing revenue. And that's key, because as they see slowing revenue, what have we seen in the labor market? We've seen non-farm payroll slow down. We've seen continued unemployment claims rise and remain near around 1.8 million. So this is all evidence of a slowing U.S. labor market, but the evidence now suggests it's going to happen all over the world at the same time. And by contrast, the new reductions aim to reduce organizational bloat and speed the decision making. The company will also pay out more in severance for most employees, which may mean we won't see them hitting the unemployment lines right away. And they're saying this is being targeted by middle managers at other companies. Defined as non-executives who oversee employees have accounted for almost a third of the layoffs last year, up from 20% in 2018. This, of course, being a big target market for Indeed. And this is where we're seeing a lot of the layoffs as companies look to trim expenses because they're seeing demand go down. And this is one of the key things. As demand falls, not only do you see inflation come down, but you also see the labor market start to break. And we're starting to get some new evidence today as U.S. jobless claims post biggest back-to-back drop, but it's not the initial claims that matter, because we're going to show you why the government is likely fudging this data this coming September. It's about those who remain on unemployment. And if you ever seen a headline like this that says wheat gains as dry weather in Russia exacerbates crop concerns, and said, man, I wish I would have known to buy wheat. Well, we actually showed our subscribers they took this trade. We showed them to buy right down here, and now they're up a bunch. You talk about our CTA Timer Pro. We show you the machine positioning, and this generates a ton of signals, because when the machines get offsides and they're in deep short positions, we show you when price rallies against them. We show you how to put those trades in and make money, and that you can see up 23.88% as of yesterday's close. How about Momentum Timer Pro? Maybe you like to trade those tentacles like the MACD, the RSI, and things like that, but you find yourself getting laid out early. We smooth that over with a proprietary overlay. Look at those returns that our subscribers are taking advantage of, and you can too with a 30-day free trial. My friends make you pay to try their reports. We give it to you for 30 days. Check it out. Link in the description below, because first-time claims decreased by 8,000 to 215, and this makes a very low number, but that's not the issue, because this, even though it marks the biggest back-to-back decline since September, the median forecast still remains a little bit higher. But the problem isn't those who are making initial claims, because what we've noted is there's quite a few people getting severances, and this is why we look at, of course, these retailers, and what are they starting to tell us right now? That people are changing their spending habits in a big way. So if you're on severance and you've only got a couple months left and you're having no luck finding a job because, well, companies like Indeed are laying off because they don't have demand for their services, what happens to spending? It goes down. And that's why we look at this chart here. We see Challenger U.S. job cut announcement. These are major corporations, and also the Worker Adjustment and Retraining Notification Act, or WARN notices. These are required by the government. You see those lines are headed higher. And look at this, U.S. initial job claims. You talk about one of the biggest labor markets in the world, and you have to wonder if this is even real. And I wonder what you think. Weigh in the comments. Do you think the government's fudging the data a little bit here just to make the numbers look good? Or do you do think that that is reality, despite the fact that we're hitting a lot of increasing notifications as companies lay off. But here's the bigger issue: continuing claims, a proxy for the number of people receiving unemployment benefits, were little changed at 1.79 million, meaning we're sitting right at that 1.8 million mark. Now, historically, that number is still low. But what is the problem here is we were told there's going to be a second half rebound in the economy, a soft landing or even no landing scenario, but we're not seeing it in the labor market, because if we were, then this 1.8 million number should be coming down. We shouldn't hear about employees starting to trade down, try to start to worry about losing their job. We shouldn't hear about retailers saying demand is falling, because consumers should be optimistic about the future, and problem is they're not. And as we look around the world, well, it's going to get even worse. And even though job cuts have slowed recently, and over the past 6 months, unemployment claims have been oscillating within a fairly narrow range, well, that's to say the least, of historically low levels, there are indications by the labor market is cooling, including a slowdown in hiring by employers. In the latest report, of course, we'll get the next one in a couple of weeks. And there's some really good reasons we're starting to see this, because going into the summer months, this is where a lot of businesses generate a ton of revenue, and they don't want to lay off. The problem is they're seeing demand weaken, and this is a problem. It isn't what we're supposed to be seeing at this time of year, but the evidence is getting clear. We talk about retail sales. We see this with companies saying that demand for their products is going down. They're starting to cut prices, and it all has to do with people staying on unemployment, because when you're on unemployment, your income goes down, your spending power goes down. Here you can see inflation adjusted or real retail sales in blue. Look at that deceleration. And what does that match with? An increase in continued unemployment claims. So you continue to see that happen going into, of course, the global financial crisis. And you see it now. You see exactly as retail sales on an inflation-adjusted basis contracted, what happened? You see unemployment claims go up. And we're hearing from employers now saying, well, if somebody leaves, we're not replacing them. We're cutting hours. You're hearing more and more employees saying, we don't have the work for our existing workforce. We're going to likely see more hours get cut, and that indeed is a dangerous situation here, because now we look at, of course, the U.S. factory sector. Here we got the global flash PMIs from Standard & Poor's, and what we see is things actually got a little bit better. Now, the manufacturing sector increased a whopping 0.9 to 50.9, showing a very, very slight expansion. It's the services sector everyone's get excited about, but that's what we should see going into the summer months, is where services really drives the economy, now up to 54.8. This is giving people a lot of hope. Now look at this. The services sector upturn was accompanied by manufacturing output also expanding at an increased pace in May. But factory production rose for a fourth consecutive month. Now that's good news, but hold on. The latest output gain was still lower than seen earlier in the year. However, thanks to weaker new orders performance compared to that seen at the start of the year, and these new orders received by factories declined for the second month running, but only at a marginal pace amid a largest export gain for the year. And that is the concern here, is we're seeing a decline in new orders. And eventually, if you don't have enough new orders to sustain your workforce, well, you start cutting hours, then you start cutting jobs, and that is the issue. Here you see employment fell for a second successive month in May, contrasting with the continual hiring trend seen over the past 45 months. The overall reduction in workforce numbers was only very marginal. However, less witnessed in April as an upturn in manufacturing payrolls. And get this is surprising, was accompanied by a slower rate of job shedding in services. So we heard before that the services sector in the U.S. was going to drive the economy, pull the manufacturing sector up. And what are we seeing in the services side? The demand is actually going down here. So you see the PMI numbers saying, look, services sector is expanding. The problem is the labor market saying, hang tight. This is about to change in a big way. And while factory jobs grew at the fastest pace in 10 months, buoyed by rising order books and improved business prospects, service employment has now fallen for 2 successive months, albeit in part due to staff shortages. And companies, again, here's the problem, sought to pass higher costs onto customers in the form of higher selling prices. Now, we just heard from Walmart, and we've heard from Target Even Apple is cutting prices. Why? Because consumers are rejecting higher prices. So we're starting to see manufacturers cut prices down. And what are we seeing at the factory level? Just the opposite here, as they're looking to drive selling prices higher. And the rate of increase of which accelerates slightly compared to April. However, although still elevated by pre-pandemic standards, the rate of inflation across both goods and services remained below the average recorded over the past year. So what we already know today is that while manufacturers are trying to pass on higher prices, they're not going to be successful at it. What they're going to do is drive demand down even more. So you think about this, people believe that maybe if you raise your prices more, demand will come. But if people don't have the money, and that's what we know consumers are facing, they're going to see those higher prices and they're going to spend less and shop less, which is exactly what we noted. Target said they've seen less foot traffic. Well, there's a reason why. If you don't have money, you don't go to the store. And the evidence is clear as we look again at real retail sales. Again, this is inflation adjusted in blue against total compensation in red. And that's form of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. But that's shown in red, both on a year-over-year rate change. And what you can note is there are periods where you see back here in the mid-90s. What happens? Total compensation growth starts to slow. Well, that means people spend less on retail sales. Sure enough, you see that happen heading into the dot-com bubble. You notably don't see it here. In 2004, retail sales continue to drive higher as compensation turns around, but that didn't last too long as we headed into the financial crisis. You see in 2012, it happened again, and now you see it here. So as these manufacturers are forced to pass on higher costs, they're passing it to a labor market who's not only concerned about losing their job, but they're seeing their hours get cut. They're seeing their compensation growth slowing, and that means, of course, the lower income classes are going to spend less, and even to the extent that the higher income earners are turning to companies like Walmart to save a few bucks. And we know this happens every time the personal savings rate gets low, and at the same time, you see, of course, total compensation grow slow. When people start looking at their savings accounts and realize they're getting near zero, well, they turn to savers, not spenders. And you can see here as the personal savings rate rises here in the, of course, mid-90s, what happens? Real retail sales heads lower. You see that again going into the dot-com bubble. It's all about savings and income here. Again, during the global financial crisis, you see it again in 2012. You see it happen in 2018. You even see it in 2022 to 2023. People start saving more as they get worried, then they start spending more and sales go up. But now all of a sudden you're seeing dangerously low levels of savings at a time when we know total compensation growth is continuing to fall. But this is not just a U.S. issue, because what we're likely to see in a matter of months if consumers do not go out and spend, and remember, they don't have the ability to. Their credit cards, we noted, are maxed out. Many people are now 30, 60, 90 days delinquent. We're seeing those buy now, pay later loans that, well, people have to pay later. That day is here now, and that means the U.S. consumer is tapped out. At time, manufacturers are going to raise prices even more. You're going to see further demand destruction. But this isn't a U.S. issue. Let's head over to Germany. We get their flash PMI as well. And what do we know? Their manufacturing PMI is still in contraction. Now, it's only contracting at a slower rate, which is good. Now only at 45, which is a fairly mild contraction. Their services sector, well, that continues to move up at 53.9. Now let's look at the details. May saw total inflows to new business rise. Now we talked about this the other day in the show of what happens is when the dollar gets too strong relative to other currencies, business starts to flow to other places. Now the problem for the U.S. is this is a labor market issue. And of course, Janet Yellen, we'll hear from her in a bit. She's got a solution. And as we see inflows to new business rise for the first time in just over a year, in a sign of strengthening underlying demand, or perhaps just people looking to save a few bucks by having business done overseas, as growth was led by a solid and accelerated increase in new work across just the services sector, and that was interesting. It was coming from abroad. Although manufacturing new orders remained in contraction, that's not good, because remember, those are the people who get paid more. The rate of decline was the weakest observed in 2 years as factory export sales came close to stabilizing. Again, currency-related issues here. You tend to see, again, jobs and production shift to lower cost manufacturers. It's all about the strong dollar. But look at this. The latest survey data, meanwhile, showed a pickup in job creation in Germany, but this is only going to be temporary as May's increase in employment, which was broadly in line with historical series average, owed exclusively just to the services sector, with manufacturing workforce numbers declining at a solid rate that was little change from the previous month, as factory job losses partly reflected spare capacity among goods producers who recorded, get this, another sharp reduction in backlog of works. And this is important because once those backlogs are done and there isn't enough new orders to sustain the workforce, watch out. You're going to see layoffs hit in a big way. And part of, again, we're going to look over here in a moment to what Janet Yellen has to say because, well, one country's trying to put a lot of people out of work and she's trying to stop it. Here we look over to, of course, the UK as revival in manufacturing production supports output growth in May. What do we know? Manufacturing PMI now into a slight expansion of 51.3 after coming out of a slight contraction. And we see the services PMI now at 52. So decelerating a little bit here, but still an expansion. But we'll look at focus on the new business because this is about the labor market and what we're seeing at companies like Indeed as new business volumes across the private sector rose for the 6th consecutive month in May. However, the rate of growth slowed to the weakest in the year-over-year date and was relatively modest. Notably, services and manufacturing recorded equally moderate uplifts in new orders, ending in a period of divergent trends between the two sectors. The rise in new business, here's key, was helped by a second successive increase in export orders after April marked the first expansion in almost a year. Again, we talk about the strong dollar and its effect on the global economy. Here you're seeing, again, demand shift from the U.S., likely overseas to Germany, to U.K. And here we see, despite sustained output growth, the flash survey results continue to signal a relatively subdued labor market in May. So despite increasing demand, employers said, well, we're not buying it. As employment levels picked up for the 5th straight month, they did so at a marginal rate and to a lesser extent than that of new business. And some firms continue to signal delays with hiring staff due to candidate shortages and cost considerations. That said, a pickup in manufacturing orders supported labor demand at some units, leading to the softest drop in headcounts among the sector in 20 months. So the problem here is we see the United States consumer, biggest consumer in the world, they've run out of money. And yes, some business is flowing overseas. The problem is once the U.S. consumer is stopped spending, well, there goes the entire global economy. And one country's trying to flood it with goods, and one woman's trying to stop it. As Yellen calls for united front on Chinese industrial overcapacity, you want to know why she's doing this? Well, they're threatened by Chinese exports, and for a big reason. This is not a bilateral issue between the U.S. and China, she's saying. Overcapacity threatens the viability of firms around the world, including in emerging markets. No, Ms. Yellen, what you meant to say was it actually affects the U.S. labor market, which you have been on record saying is strong and robust, is going to drive the U.S. economy. The problem is it's not, because now we're seeing around factories around the world too much capacity, not enough demand. That means a bunch of people are going to get their hours cut and eventually hit the unemployment line, and that's going to lead to, of course, massive layoffs and a massive global recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.